Welcome to this video on property taxes. The following topics are going to be covered in this video. First, we are going to define what property taxes are and look at the administrative steps in establishing and collecting property taxes. Then we are going to move on to property value determination and what are called assessment values. And then we are also going to talk about the tax rate setting. Next, we are going to look at various measures related to equity and property tax policy. And finally, we are going to look at property tax evaluation regarding equity, efficiency, adequacy, and so on. A property tax is basically a tax on the market value of privately owned property. Theoretically, it is a wealth tax that could include not only home values or homes, but also personal property. In order to include all property would be administratively and politically very unfeasible. Imagine if you had to pay a property tax, for example, on the computers you own. Usually, agricultural land, commercial, industrial, and residential homes are included in the property tax. There are exemptions, for example, public property, cemeteries, religious places, or also universities are exempt from paying property taxes as long as they are used for the intended purpose. Note that property taxes are the most important taxes collected by local governments, for example, counties and cities and municipalities, and they account for about 72.5% of local tax revenue. Basically, property taxes are the economic basis for local autonomy. There are some key administrative steps in dealing with property taxes. So first, of course, you have to identify all the properties to be taxed in your jurisdiction. And then you have to do something which is called assessment. And we will see that this is very important and also very tricky. Basically, the assessment quantifies the property value, that is the tax base, of the property tax. Note that we will also then have to establish the tax rate. So if you compare this if you compare the property tax to income taxes or consumption taxes, then you will see here that the key difference to those taxes is that the government is actually setting the tax base through the assessment, and it is also setting the tax rate. So this will be a key difference. The assessment or the determination of the property value or the tax base is actually one of the key difficulties associated with property taxes. And in this video, we are going to look at various methods of how this value can be established. We will also see that there's a trade-off between setting the tax base and setting the tax rate. And then, of course, once you have identified the properties, you have assessed their values and you have assessed the rates, then the last step would simply be the collection of the tax revenue. Now, let us have a look at the property value determination. So the goal of property value assessment is that you get an accurate and up-to-date estimate of the market values of properties. Recall that here, when we talk about properties, we mean residential homes, commercial and industrial plants, and also agricultural land. And of course, the quality of the assessment, in the sense that it is accurate and up-to-date, is also important in terms of the fairness associated with the property tax. But of course, there's a trade-off between an up-to-date and accurate assessment and the cost, in the sense that you have to, when you determine the property value or the assessed value, then the more accurate you want to get or the more up-to-date you want that estimate to be, the higher the administrative costs are. Now, there are various values associated with the property. There's the market value, the appraised value, and the assessed value, and we have to define them first before we continue. So the market value is basically what the market would value your property, in the sense that if you were to sell your property. Here, the market value also assumes that there is full information and that those markets are actually functioning, or the home markets are functioning. Next, we have the appraised value that is usually determined by a professional appraiser, and the appraised value is of importance for mortgage lending purposes. We also have the assessed value, and the assessed value is actually relevant for property tax purposes. The assessed value is likely very different from the market or the appraised value in the sense that the assessed value is usually set below the market value. The assessment is usually conducted at the local level, in a sense by municipalities or by counties, and seldom at the state level. Note that the market value and usually the appraised value are also easily defensible in the sense that you can justify them by observing market transactions that are occurring, whereas the assessed value can be a little bit more tricky. That's also the reason why it is usually set below one as a fraction of the market and appraised value in order to leave some leeway. Now, there are various methods to assess the value of a property, and here we are going to look at a comparable sales approach, we are going to look at a cost approach, and also the income approach. Now, the comparable sales approach is probably the approach that you may have heard before, in the sense that this is often used for residential properties, where the appraiser or where a person would look at the home values or the transactions in a particular neighborhood, and based on the properties of the houses that have actually sold and the house in question, that you would assess you would calculate the market value of that house, even if it is not on the market. There's also for industrial and utility properties that are usually not changing hands on a regular basis. There's the reproduction and the replacement cost, in the sense that the reproduction cost would be the cost of constructing a replica at current prices, or the replacement cost would be the constructing a similar unit using current technology. Now, the final approach can be used for, say, multifamily homes or apartment complexes. So here, let me give you an example, and note that this example is very similar to what we have seen about the net present value. So consider that you have a 10-unit apartment complex, and each of those 10 units rents for $1,500 per month. The expense rate is that about 54% of gross income is going for expenses, for example, maintenance and repair, and that on average you have about a 6% vacancy rate. Also here, and this is very important, we have to set the discount rate, and let's assume that here we are setting this discount rate to 5%. So hence we can do the calculations in terms of what is the profit, the yearly or the yearly profit associated with this property or this unit apartment complex. So here we have $1,500 per month. We have 10 units. We have 12 months, and then we can calculate the gross income taking into account the vacancy rate, and we see that we have an annual income of about $169,200. We also have expenses associated with this apartment complex, and this is the 54% of the gross income. So here this would amount to $91,368. And based on the income and the expenses, we can calculate the profit per year. And that would amount to about $71,832. Now, if you recall, when we talked about the net present value, then here we can simply take the net income per year divided by the interest rate, that would be, or the discount rate of 5%. And we will see that the present value is about $1.4 million. Okay, so here the $1.4 million would actually represent the value of the property, since you are receiving this revenue in perpetuity. Now, we talked about this before, that there's also the so-called assessment ratio. Basically, the assessment ratio is the assessed value as a percentage of the market value. Usually that is set by state finance laws to differentiate different classes of property. For example, commercial, residential, or agricultural property. Usually, there are lower rates for residential as opposed to commercial and industrial property. And the assessed value would simply be taking the market value. For example, think about the value we had before of $1.4 million. Then if the assessment ratio is at, say, 0.9, then the assessed value would be 0.9 times the $1.4 million. Now, the reason why we have different assessment ratios is that there's a perception of fairness, also of in terms of how much can people or various entities afford. And it is also a way to, for example, slow urban sprawl if you're taxing agricultural land at a lower rate than you would do residential properties. Then let us next talk about the so-called assessment cycle. In a sense, we have seen that we have to determine the assessed value, which is equal to the tax base. And then the question is, how often do we actually update the assessed value? So there could be, for example, the cyclical assessment, in the sense that all properties are assessed in a particular assessment year. So that could be every, say, 2 or 3 or 5 years. And then this assessed value remains fixed until the next scheduled assessment. Note that, of course, if the cycle, or if the cycle is too long, so for example, if it's 5 years, then a lot of things can happen to the market value or the actual market value of the homes. So there could be significant changes. Then we can also have what are called is a segmental assessment, in the sense that a fraction of all properties are reassessed every year. So for example, we can have an assessment of 1/3 of all properties in a particular county every year. So that means that a particular property would be reassessed every 3 years. We could also have an annual assessment, which is possible with the improvements in technology. So think about, for example, if you're going on a particular real estate webpage, then you can see that the estimated value for each property. Then the annual assessment would be possible if you assigned value to each characteristics of the property. So for example, if you're going on the webpage of Marion County's treasurer, then you can download for each property in Indianapolis, you can download the certain characteristics, or a PDF with certain characteristics. And based on those characteristics, I think, for example, a square footage, you could then adjust the market values on an annual basis. There's also the last possibility is also do the assessment on sale. However, this could be potentially problematic. The assessment on sale would be that you take the market value at when the property is sold, but that of course assumes that the properties change hand on a regular basis. This may not be the case. So imagine if you have a family that lives in their house for 20 years, then you would not have that home assessed. You would be lacking assessment for 20 years. Now we have talked about the assessed value or the tax base. So now let us talk about the property tax rates. So the property tax rates can be actually set as part of the annual budget process, in the sense that we have this equation here, where we have the budget expenditures, we have the non-property tax revenue, and then we have the assessed value. Okay, so basically you would have the term here would be the amount of money you would need to raise from the property tax. Okay, so let us do an example here. So before we do the example, let us talk about two additional things, and that would be the what is called the mill rate. Now, very often property taxes are quoted in mills using this so-called mill rate. So that would be $1 for every $1,000 of assessed value. Okay, So for example, the relationship here between the mill rate and a regular tax rate that is expressed in percent would be the mill rate divided by 1,000 would give you the tax rate. So for example, if the mill rate is set to 7, then the tax rate would be 7 divided by 1,000, and that would be 0.7%. So the tax revenue then would be the, based on the tax rate, would simply be the assessed value times the tax rate, would give you the tax revenue. And if this was the mill rate, you would have the assessed value divided by 1,000 times the mill rate. So here we have now an example of how this would actually work. Okay, also based on the formula about the non-property tax revenue. So imagine that you have a particular jurisdiction and they have $220 million of assets, of market value, which is the market value of the homes. And suppose that the assessment ratio is 0.5 and that there are in total about $3 million of exemptions. The total budget is $3.5 million and you have non-property tax revenue of $0.75. So what this means is that the tax that you are imposing has to raise $2.75 million. So how do you determine the tax rate here? So what you're doing is you have the $220 million of assets times the assessment ratio gives you the $110 million. And then you are subtracting the exemptions. So you are left with $107 million of basically the net assessed value. Then the rate would be simply the 2.75 divided by the 107. So a property tax rate of 2.57% or a mill rate of 25.7. Now let us talk about public services and property tax rate setting. Suppose that you have a jurisdiction and in this jurisdiction you have 6 parcels. And I have labeled those parcels A through F. Now you have various assessed values with each of those parcels. Okay, so note that this is always the same of 100, 50 and so on all the way to 100 for parcel F. And then you have 4 public services. You have schools, you have wastewater, you have fire, and you have library. And you can see the districts of the various public services are actually color-coded. So for example, you have the school district. So you have in school district 1, you have parcel A, B, and C. And in school district 2, you have parcels D, E, and F. Now, note that the school districts are different from, for example, the fire districts, where you have 2 fire districts. You have parcel A, B, D, and E in fire district 1, and you have parcel C and F in fire district 2. Okay? And so note that here, even in for wastewater and also for library, you even have 3 different districts. Now the question is that how do you tax those properties, knowing that the expenditures associated with those various public services are not necessarily, that the districts are not necessarily overlapping. And so this is what we are going to do next. So here you have a summary of the information that we have seen in the previous graph. So in the sense that, let us stick with the example of school districts, where you have school district 1 and school district 2, and that parcels A, B, and C are forming school district 1 and parcels D, E, and F are forming school district 2. Now note that the property tax base associated with school district 1 is 350. Note that you obtain this value by summing up the assessed values of parcels A, B, and C. Note that those values are $100, $50, and $200 respectively, for a total of $350. So for school district 1, you now have the tax base of 350 and you have the tax base of 450 for school district 2. We also know, and suppose that you know this from previous budgets, that you have the expenditure of 20 associated with school district 1 and an expenditure of 10 associated with school district 1. And hence, based on those values, you can calculate the millage rate for the 2 school districts. So you would take the 20 divided by 350, and that would give you 0.0571. Okay? Now you can do the same for school district 2, and you would get the millage rate of 10 divided by 450. You get 0.0222. Okay? And you can do this for the other values. So you get 0.02 for the wastewater district 1 and 2. You get 0.0167 for wastewater district 3. And then you just can fill in the values and note that you have those values in the slides. Okay. So here you have the various rates. That is associated with the public services or the expenditures of the public services and how they relate to the tax base. So now let us move to the second table here, where we have to allocate those rates to the various parcels. Because note that in this case of parcel 1, you have the value of 100, 50 and 200. Of parcel 1, you have the value of 100, parcel B is 50, parcel C is 200. Okay, and so parcel A, for example, is in school district 1, waste district 1, fire district 1, and library district 2. So what this means is you have the parcel A in school district 1 with a millage rate of 0.0571. So that is the millage rate for the school district. For the wastewater district, it is 0.02. And for the fire district, it is 0.08. And for the library district, it is 0.1. And hence, the entire value here for parcel A, okay, so the millage rate would be 0.2571. Okay. Now you can calculate that for all the other parcels. So for example, for parcel B, you would get 0.2771. And then you can basically, from there on, you can calculate the tax liability for each of those parcels, which would be simply the rate times the value of 100. So the tax bill for, say, parcel 2, that has a value of 50, and the rate is 0.2771. You would then have a tax bill of 13.86. Okay. And again, you have the complete values in the slides. So just to summarize what we have seen, we have those jurisdiction with 6 parcels and 4 public services. and we have expenditures associated with those public services that we have to distribute to the various parcels. So here we have the expenditures, where we have again the expenditure of school district 1, and we have the rate, and we have that for every public service. We are determining what type of rate is necessary to cover the expenditures. Now then, what we do, we have those various types of expenditures, and we have to distribute them for over the parcels. So all the rates that we have seen in the previous slide for School District 1, Wastewater District 1, Fire District 1, and Library District 2 that are associated with Parcel A have to be summed up to get 0.2571, and then multiplying the rate by the value, you are getting the tax bill. Next, let us look at some technical aspects of property taxes. So here we are going to look at various measures, and those measures are related to to equity, and they're also related to policy. Okay, and so we are going to look at measures of dispersion of assessed values. That we are going to look at the coefficient of dispersion, and then we are also going to look at the progressiveness of the tax, and we are going to use the price-related differential for that. We are also going to look at two property tax relief measures, and again, this is for equity purposes, and we are going to look at the homestead exemptions and the so-called circuit breaker. So let's talk about the coefficient of dispersion first. So the coefficient of dispersion is basically a measure of the assessed value and how it affects horizontal equity. What it means is it is the average deviation around the median assessment ratio as a percentage from the median. And it basically is an indication of whether the assessed values are clustered around the median or not. Usually a smaller value is better. So the acceptable range of the coefficient of dispersion value is between 10 and 15% for residential property and 15 to 20% for commercial property. So what does this mean in reality? So let us do an example here. Consider this situation where we have three properties, A, B, and C. And the market value of those three properties is $40,000, $60,000, and $100,000. The assessed value is $25,000, $30,000, and $40,000. And then you can see the assessment ratio of 0.625, 0.5, and 0.4. Okay, so you are getting those values by dividing the assessed value by the market value. Okay, so 25,000 divided by 40,000 is 0.625. So note that here the median assessment ratio is 0.5. So here. So what this means is that 0.5, that 50% of properties are above 0.5 and 50% of properties are below 0.5. Okay, and hence the difference from the median. And note that here you are actually dropping the sign. So it doesn't matter whether it is below the median value or above the median value. We are only looking at the difference from the median. So here the difference from the median is 0.125, 0, and 0.1. And the average difference from the median, you see here, is 0.075. Then the coefficient of dispersion is basically measured as the average difference from the median divided by the median. So the 0.075 divided by 0.5. And here you are getting then the coefficient of dispersion of 15%. So what that means is that the average of the assessment ratios is within 15% of the median. Now, the price-related differential is slightly different in the sense that it measures the progressiveness of the tax. So if the PRD is equal to 1, we have a proportional tax. If it's above 1, we have a regressive tax, and if it's below 1, we have a progressive tax. So here I have taken the equation here of how this is measured, but I think it is easiest if you are actually doing an example to illustrate this equation. So here we have an example with 5 properties, and consider the market value of those properties ranging from $50,000 to $250,000. Now assume that you have the assessment, okay, and note that here we are looking at 2 cases. We are looking at a progressive case where we have a progressive tax, and we are looking at the case where we have a regressive tax. So here we see that the assessment value of the first property is $35,000, and the assessed value of the last property is $237,500. So here you see that the assessment ratio is going from 0.7 to 0.95. So those values would correspond to this term here in the equation. Okay? Now here the 1 over n is you are taking the average of those values, and when you do take the average of those values, you get a 0.84. Okay. Now the denominator here, we have the sum of the assessed values divided by the sum of the market values. So here we have the sum of the market values is $625,000, and the sum of the assessed values is $552,500. Okay. It's $552,500. Okay. So when you do take the ratio, you get 0.884, and hence the price-related differential would be the 0.84, which we have calculated before, which is the average of those assessment values, divided by 0.884, which gives us a ratio of 0.95. And here you see that the tax is actually progressive. You can do the same calculations for the regressive example, where you can see here, for example, that the 0.9, it goes from 0.95 to 0.7. And here we actually do have a regressive tax. Now next, let us look at some property tax relief measures. And here we are going to look at the homestead exemption and also the circuit breaker. Basically, the homestead exemption is an absolute reduction in the taxable property value or in the assessed value. For example, that could be $30,000. So you basically subtract the exemption from the assessed value to calculate your tax. Here, you have to note that the lower the home value, the higher the percentage reduction in taxes. Okay, in the sense that there's a higher percentage reduction for low-income households, because usually those low-income households also live in homes with a lower value. However, the homestead exemption is that it only applies to homeowners and not necessarily to renters. So here the advantage is that you have tax relief, and that you have improved vertical equity for lower to middle income homeowners. Of course, the disadvantage is that this is not helpful for renters, who are often lower income households. Plus, when you have cities that have a large proportion of renters, then this may also be not helpful to cities. Now here we have an example of how this would actually work. So imagine you have 2 properties. The first one is valued at $100,000 and the second one is valued at $50,000. We have the assessment ratio, and we also have the assessed value which would give us the assessed value of $70,000 and $350,000. So we have the exemption, which we are not going to apply yet. But so when you're looking at the tax rate of 4%, then without the exemption, we would pay the 4% on the $70,000 and the 4% on the $350,000. So the tax liability without the exemption would be $2,800 and $14,000 for properties A and B respectively. And then without the exemption, you would have the real tax rate of 2.8% for both properties. Now, with the exemption, what you would be doing is you are subtracting the $30,000 from the assessed value, and hence the tax liability with the exemption would be 4% of the $40,000 and 4% on the $320,000. And you see that for the high valued property of $500,000, the real rate with the exemption is actually going down, is going down by a little bit from 2.8% to 2.6%. But the real tax rate goes down significantly for property A from 2.8 to 1.6%. And note that those exemptions here are actually measured, or the real rates are measured as a percentage of the tax liability with respect to market value of the home. Next, let us look at the so-called circuit breaker, which is also a measure of property tax relief. So basically, the circuit breaker is providing a tax credit on the state income tax for property taxes. So note here that the tax credit is not applied to the property tax, but it is applied to the income tax. Okay? So here the structure is the following, or the equation is the following. So here we have the tax credit, which I denote R, and then we have P, which is a percentage specified by law and is usually declining with income after a certain threshold. Then we have the property tax minus the excessive burden specified as a percentage of income. So since this is not very intuitive, let us do an example. So consider the following situation where you have an income of $30,000 and you have a property tax bill of $2,000. However, the state considers a property tax burden of more than 5% of your income to be excessive. So what this means is that in order for the circuit breaker to work, or how the circuit breaker works, is that you calculate the 5% times your income, so that would be $1,500. So the $1,500 would be the amount the state would consider to be the limit that you can spend on property taxes. So you have the $2,000 minus the $1,500. So basically you have $500 of this excessive burden. And then the state reimburses or gives you a tax credit of 50% of that. So 50% of $500 would be $250. Now, let us do a slightly more complex example where we have the tax credit limit of $1,200. And then we also have the credit reduction. Okay, so here I set this in the above example, I set this reduction, or the P, this term here, to 50%, but this 50% may actually vary by income. So for example, that the tax credit may be 100% of the excessive burden for very low income households, but then it's decreasing over time. So here what I do is that the P here, or this value here, is 100% for incomes of $30,000 or less. And then it is decreasing by 10 percentage points for every $5,000 above the $30,000. And here we are looking at the K of 4%. Okay, so not 5%, but 4%. So here you can see of how this would actually work, or how this, what the income tax credit would look like for three different cases. When we have a property tax of $1,000, of $2,500, and of $5,000. So here you would see that, for example, that if you are a household with an income of $60,000, then if your property tax bill was $1,000, that you would not get any tax credit. You would get a little bit of a tax credit when your property tax is $2,500, but you would get a lot of credit if your property tax bill was $5,000. Okay, and so here you can see of how this would vary by income, how the tax credit would vary by income. So the advantages and the disadvantages of the circuit breaker is that you have a property tax relief that is targeted to lower and middle income homeowners, and you can also benefit or take into account renters. The benefit is that it is declining with income, but of course the disadvantage is that households can only benefit from the circuit breaker if they actually file an income tax return. Now last, let us look at some evaluation criteria, and note that we have covered some of them already when we talked about equity. So when we are talking about equity, remember that equity represents the tax burden relative to the ability to pay. And here, since we are talking about property, there are two possible measures with different problems associated with them. So, for example, you can calculate the effective tax rate as the taxes divided by income, or the property taxes divided by income, or the property taxes divided by the market value. This may lead to issues regarding horizontal equity. Remember that the horizontal equity is that you have the same taxes given the same ability to pay. So, for example, you can consider households that may have the same income, but that the market value associated with the home of one household is significantly higher than the market value associated with the other household. Or you can also have it slightly different. Suppose you have the market value of two homes is identical, but you have income differences. Okay, then there, when you are calculating the measures associated with horizontal equity, that there could be issues. You can also have issues of vertical equity, in the sense that for residential properties, it's clear that the tax burden is on homeowners. But then when you have, say, rental and business properties, the tax burden may be on the landlord, the tenants, or the owners of the business, customers, etc., depending on the market condition. In the sense that for rental and business properties, the issue is that the landlords and also the business owners, of how much can they shift the burden actually to their customers. So here, let us illustrate this example about equity, and consider that we have three families here, A, B, and C, and that they are varying significantly in household size. In the sense that we have one family, the family A, that has 8 people in the household, earning $80,000, and then we have household C, who is also earning $80,000, but that the household size is considerably smaller. So here, when you click on this link, there's actually so-called adjustment factors, and we have the adjustment factors of 1.32, 0.8, and 0.8 based on household size. So think about here, the basis would actually be a household of 4 people. For a household of 4 people, the factor would be equal to 1. So what this means is that if you have the household size of 8, that it is 32% more expensive to have a household of 8 than a household of 4. That's basically how you would interpret those adjustment factors. So based on those adjustment factors and the income, you can calculate the adjusted income that you have now is $60,000, $60,606 for household A. And you can see that household B is significantly better off in terms of income because you only have 2 people. Then we have the assessed value of the various homes and the tax rates. And hence you can also then calculate the tax liability of $5,000, $2,000, and $5,000 for those 3 families. Now, if you then calculate the effective tax rate based on the adjusted income, so what this means is you are taking the $5,000 and divided by the $60,606, you see that the effective tax rate would be actually 8.25%. And for the family A, it would be 5% for family C, okay, in the sense that here you would basically have a regressive tax. Now, when we talk about the evaluation criteria, we also talk about the efficiency, in the sense that what economic decisions are distorted by the tax, by the property tax in this example, or in this case, and also what is the magnitude of those distortion. So here, of course, the economic decision is basically associated with the consumption of home ownership, if you will. So in the sense that there's the investment decision, and also the location decision of individuals and firms based on the property values and based on the property taxes associated with a particular jurisdiction. Note that here, with regard to adequacy, that you do have a very large tax base, but of course there can be differences in wealth. So if you're comparing two communities where you have very low income or many low income properties in community A and high income properties in community B, then of course the services that can be offered in both communities would be very different. And this is basically based on differences in wealth. And in terms of elasticity, in the sense that if we have economic growth, then the question is, how does the tax revenue actually increase? So how does the growth in income actually relates in an increase in property tax revenue? And here you would have to think about that the mechanism would be that you have income growth, and this would change the market value of homes, and then hence you also have a change in the assessment value of homes. Usually, property tax collection is relatively feasible, since you do have the property tax records. And the most difficult part would be actually the assessment, in the sense of how much are the properties actually worth. From a political feasibility one, the property tax can be tricky, because usually you do have lump sum payments, say annually or semi-annually, and the tax is very, very visible to homeowners. There's also political hesitation to increase commercial rates, because there's the concern that commercial or industrial rates, because there is the concern that businesses leave the jurisdiction. In terms of stability, remember, stability is how much does the value fluctuate over time, or the tax revenue fluctuate over time. And since we do have a very broad tax base, there's usually little fluctuation. Also remember that the property tax is different from other taxes, since the tax base as well as the tax rates are set by the government.